Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. I hope that each and every one of you is safe and doing well with your families. This is episode 106 of your Tax-Free Life podcast. As every week, I'm excited to be here with all of you, and today is going to be one of the best podcasts that we are bringing to you live at this point in time. And the name of this podcast is called While You Play Checkers, the IRS is Playing Chess. So I'm going to walk you through a lot of things that most of you may have heard about in the past, but have not really paid any attention to. So we're going to be talking about qualified accounts. We're going to be discussing the good, the bad, and the ugly, the pros and the cons, and some of the suggestions that I'm going to have for each and every one of you in order for you to be able to minimize your tax liability in retirement as you prepare for a wonderful retirement life. Now, I'm going to have in this episode, I'm going to have 4 areas that I'm going to cover. The first one is the game of checkers in retirement, and this is a game that most of you have been playing for many years. Then option number 2 or section number 2 will be the issues to consider at retirement. Section number 3, I'm going to turn over to the IRS, and this one is called the IRS Game of Chess in Retirement. And then section number 4 would be the different strategic options that all of us and all of you may have and should have at your disposal in order to minimize all of the issues that we're going to be discussing with that today. So this may be a little bit longer, so I don't care what you're doing. Make sure you pay attention. If you're driving, just go around the block a few more times so you can listen to the entire podcast. But again, once again, I'm here to provide you with education, because although there's more information in the marketplace than ever before, Americans are actually worse off than they've ever been. So at the end of the day, information without education always leads to failure. So let's get started. Let's talk a little bit about the game of checkers in retirement. And this is a game that, like I said at the very beginning, each and every one of you is playing on an ongoing basis. Now, from a business perspective, when we discuss a game of checkers, first thing is all of you are making pre-tax contributions to your retirement accounts. Actually, many of you think that you're saving money on taxes. Number 2, you're enjoying a tax deduction every year, and that you're doing because you're putting money away into a pre-tax account. Whether it's a 401k, an IRA, a SEP, a TSP, a 403b, or many of the other retirement accounts that are available in the marketplace, also for business owners or self-employed individuals and so forth. So you're making pre-tax contributions. You're enjoying the tax deduction year to year on these accounts. And by the same token, you're also enjoying the tax-deferred growth that you're getting on those accounts if there's growth in that account, because if there are losses, then you're probably not enjoying the losses on the accounts. You're also enjoying the compounding effect of retirement assets year to year. So that means that the money that you put into a qualified plan is going to go in pre-tax if it's a pre-tax qualified plan. And the money's going to grow tax deferred, so you're also compounding the growth of that money on a year-by-year basis, on a pre-tax basis. And one of the major hopes that all of you have, because of the fact that you are maximizing your contributions to 401ks and IRAs and SEPs and 403bs and TSPs, and if you have drop money as a public employee as well and so forth, is you're hoping to be in a lower tax bracket in retirement. And that's going to be a big if, because I would venture to say that the only way you're going to be in a lower tax bracket in retirement is if you have been a financial failure for your entire life. And then obviously you're going to retire at 65 and you hope to live happily ever after. So I think most of us understand that. I make contributions to my qualified plans. Now I do it from a strategic standpoint. And also I do it only up to the optimum amount that I want to maintain in those accounts. Because obviously that's a tax-deferred account from that perspective. So let's go into section number 2 now that we've talked a little bit about the game of checkers in retirement. And by the way, the game that you're playing by making all those contributions and maximizing your contributions to those retirement accounts, the IRS, from a strategic standpoint, thinks that and knows that you are playing checkers with your money. Now, Section 2 will deal with the issues to consider at retirement. So what would be some of the issues that need to be considered once each and every one of us and each and every one of you reaches retirement age? The first question that you need to ask to yourself is, where do you think that taxes will be in the future? Now, you know what has happened with our national debt. Obviously, we owe more money today than ever before. So depending on which publication you listen, it's north of $23 trillion. And obviously that's a major amount of debt. But that's not the whole picture, because if you take a look at the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt is now hovering around $126 trillion. Now, we really haven't factored in what is happening now with the COVID-19 virus that we're going through, which is not only a medical and scientific human virus that we're dealing with, but is also an economic virus because our country has been on a standstill for a year. We have a very large amount of the population that is now totally unemployed. Obviously, businesses are going to be closing. Bankruptcies are going to go through the roof. Home ownership is going to decline. The real estate market is going to suffer. So all of these things are a compounding effect of the catalyst of the COVID-19. Now, at some point in time in the future, all the money that the government is putting out, we're up, 2.2 trillion. There may be another 4 trillion coming down the pike in a couple of months or so. All of that is going to have to be added on to our national debt, and that's going to accelerate the compounding effect of taxes in the future. So for those of us that have a little bit of common sense, although I do understand that common sense is at least common of all senses. If I ask a question again, where do you think that taxes will be in the future? And whenever I do seminars and webinars and I ask this question as a poll, the vast majority of people that answer the poll tell me that taxes are going to be a lot higher in the future than they are today. So if that is the case, then why are you making so much of your contributions to retirement plans on a pre-tax basis? Because not only are you postponing the tax by making a pre-tax contribution, you're also postponing the tax liability. And if taxes are going to be greater in the future than they are today, then where do you think you're going to find yourself? You're going to find yourself in international waters on a dinghy with no paddles whatsoever. Now, the next question that you should be considering and asking yourself is, do you prefer compound interest or simple interest? Now, the simple answer to that is, if I have a choice between compounding my money versus, getting simple interest on my money, I'm going to take compounding, 100% of the time. And all of you are going to say the same thing. The reason why you want your money to compound is because you want to use that multiplier effect that is going to make your assets grow a lot faster than if your money was instead of compounding, it was going up by simple interest being paid on the original contribution every single year. Now, when I ask the next question that has nothing to do with the compound interest, then the answer that I get is usually totally different than the answer on the compound interest. And this question is, well, do you prefer compound tax or simple tax? Now, at this stage of the game, what I would suggest is for you to stop, pause for a second, start looking at your assets through a telescope as opposed to a microscope, and try to answer this question. Because in a perfect world, you would want to have no tax being assessed on your retirement accounts whatsoever. Now, that can be accomplished, but you have to start working on that decision and on those options immediately. You cannot wait another year, another 6 months, another 3 years, 5 years. You have to start doing that immediately, because you need to start making some paradigm shifts as to how it is that you save for retirement. But let's say that we're not in a perfect world and we're in something that is less than perfect, but most important would be a lot better than what you're doing today. So the question is, well, do you prefer compound tax or simple tax? All of you are going to say, well, I'd rather have simple tax. So you want compound interest, but you also want simple tax. Now, you can accomplish this, but you have to be able to create and put together retirement straddles that will allow you to do that. We don't have the time to go through what a retirement straddle is, but trust me, I do it every single day for my clients, and they're very, very happy when I come up with a solution and a system that would allow them to do that. Another question that you should be asking, because of the fact that you're playing checkers with your retirement money, is what percentage of your retirement income would you like to have taxed? I have asked this question at least 1,000 times in my webinars and my podcast and my seminars that I do on a monthly basis. And I've done hundreds of those throughout the United States for the past 30 years as a retirement strategist and tax planner. And the answer that I always get from all of the attendees, including my online community, when I ask what percentage of your retirement income would you like to have taxed, the answer is 0. They would want all of their retirement income to be tax-free. The problem is that because of the fact that most of you are playing checkers with your money, 100% of your retirement income is going to be taxed in retirement. So what you want to do versus what you're doing are two different worlds and two different things. Another question that you should be considering is what percentage of your income would you like to have guaranteed? Again, when I ask this question all throughout the entities and the people that I get in front of on a regular basis, they all tell me the same thing. Bert, I want 100% of my income to be guaranteed if possible. Well, the answer is yes, it can be done. But the true answer is that most of you are doing totally the opposite. Unless you have a guaranteed pension from an employer, whether it's a private employee or a public employee, and unless you're receiving Social Security benefits, those are guaranteed. But everything else that you're doing from a retirement distribution standpoint, none of it is guaranteed. And there's a very, very high probability that most of you listening to this podcast are going to run out of money before you run out of life. So that's another consideration and another issue that you must take a look at as you're playing this game of checkers with your money, and also not only with your well-being, but also with your family's well-being as well. Another question that you should be asking yourself is, well, Bert, what percentage, or this if I were asking the question to myself, but you should be asking this, is what percentage of your Social Security benefits would you like to have taxed? Now, I know what all of you are going to say, although many of you have seen some of the podcasts that I have put out in the past and some of my videos and my webinars and so forth, I know you're going to say, well, Bert, wait a minute. Social Security, when I make contributions, that was a tax that the government was charging me. I don't think I would pay taxes on my Social Security benefits. And the answer is that most of you are going to pay a lot of taxes on your Social Security benefits. Many of you are going to pay taxes up to 85% of your Social Security benefits are going to be taxed. Some of you, 50% of your Social Security benefits will be taxed, and that's a lot better than 85%. But in a perfect world, and if you do the proper tactical retirement blueprints and the proper retirement straddles, then 0% of your Social Security benefits should be taxed. But in most of your cases, the answer would be 85%. And then the final question that you should be considering at this point, once again, because you're playing checkers with your money and not playing chess, is would you like to pay a higher premium on Medicare? Most of us and most of you know that you take Medicare when you get to the age of 65. You have a 7-month window to apply for Medicare, and make sure you stick to that window, because otherwise you're going to have a penalty that will be assigned from Medicare for the rest of your life. And the 7-month window is comprised of the month of your birthday, 3 months before, and 3 months after. So once you hit that window, once you hit that gap, then you need to apply for Medicare, because otherwise you're going to have a liability that is going to be exposed and is going to be added to your premium every single year for the rest of your life. Now, when it comes to Medicare, the more money that you report, the more money that is taxable in retirement, and that not only includes your Social Security benefits, your ordinary income that you may be generating from, continuing to work on a full-time basis or a part-time basis, or you have a new business and where you're receiving 1099s or K1 distributions, any distributions that you're making out of your retirement accounts are going to be added to the calculation to determine not only what percentage of your Social Security benefits is going to be taxed in retirement, but also where does your Medicare premium go. You also have to add dividends and capital gains that you may receive for the year to the same equation. And then last but not least, any interest that you receive from municipal bond funds and so forth, or any type of municipality that will pay you tax-free income. Although the income is received generally free from federal income taxes, those numbers get added on to the overall provisional income calculation to determine, what percentage of your Social Security benefits are going to be taxed. And then depending on how high that income would be, and for many of my clients is fairly high, then now Medicare actually will penalize you for making too much money in retirement, and they will actually add an excise tax in the form of an additional premium in order to offset that amount of money that you're making in retirement. So, once again, those of you that have been playing checkers and you're making all these contributions on an annual basis, and you're doing so on a turnkey basis, or you're doing so pretty much blindfolded from a business perspective, start paying attention. Make sure that you talk to someone that can do a tax planning report for you, which is something that we specialize in. Because at the end of the day, you want to reduce those liabilities in retirement, because if you can retire and reduce your tax liability by, 25, 35, 40, 45% at least, and you can do that, you can do even more if you have time on your side of the ledger, then your retirement life is going to be much, much better than someone that doesn't have the ability to reduce those tax liabilities from a business standpoint. Now, let's talk a little bit about Section 3, which is the IRS game of chess in retirement. You see, as I have been telling you on this podcast, you play checkers, the IRS is playing chess. Now, why is the IRS playing chess with your money while you're playing checkers? Well, let's go through some of the points that I think will be very important for all of you to start thinking about as you go through this process that we're going through today in this podcast. A, the IRS has something that you don't have. They have time on their side. So they can play the long game with you for as long as possible. And what does that mean? Well, when you make money to a pre-tax qualified account, and you're taking that tax deduction. So let's say that you were making a $10,000 contribution to a traditional savings account. Well, if you were going to make a $10,000 contribution and you were in the 30% tax bracket, I'm just going to round it off for simplicity's sake, then $3,000 you would pay in taxes to the IRS, right? And then the other $7,000 you could invest in a mutual fund, in a CD, in a money market account, wherever it is that you want to do it. That would be non-qualified money, okay? But if you're putting the same $10,000 into a qualified account, like a 401k, 403b, IRA, SEP, TSP, DROP, etc., as we've talked about, then the IRS is actually loaning you those $3,000 that you would have paid them in that year, and they're giving you a loan. So now you're putting the $10,000 in as opposed to only $7,000, which still represents your side of the money. See, the IRS is never going to lose control of their money. So you're going to put that money in, and obviously that money is now going to grow on a tax deferred basis. So remember, it's a loan. It is a deduction to you, but you're going to have to pay with your life at some point in time in the future. Now, another thing to consider is that, the consumer, each and every one of us, assumes all the financial risks. So the IRS assumes none. So the money that you're putting into your 401k and your other qualified accounts, you're assuming 100% of the risk. Your asset allocation risk, your volatility risk, your stock market volatility issues, and that we're living through today. So you're going to carry all the risk, and the IRS is going to carry none. The IRS also controls the business relationship. See, when you start putting money into qualified accounts, you're actually putting money into a company that the IRS opened up for all Americans in the United States that pay income taxes. And the IRS is the managing partner. They are the CEO and they are the CFO on this company that they opened for you. As you start putting money into that company, you become a minority shareholder if you think of it from a corporate ownership. So the IRS is going to control the contribution limits. They're going to control the access limits. When can you have access to your money? They're also going to control the distribution requirements. So not only are they going to put a limit as to how much money you can put into the account every year, they're also going to tell you by when do you have to make those contributions. If you take money out prior to age 59.5, unless you meet certain exigent circumstances, they're going to charge you an additional penalty, an additional tax, or an additional interest, as you may want to call it, on that money. Then after that, up to the age of 70.5, if you turn 70.5 last year in 2019, or 72 under the new rules, then you can take money out anytime you want. But once you get the age of 70.5 or 72, depending on your personal circumstances, Now the IRS is going to force you, or that senior partner that you have, that managing partner that you have in that company that you're making contributions to, they're going to force you to start taking money out whether you want to or not. So they have age requirements that they fully control, and there's nothing that you can do about that. And then probably the worst of everything is that they also control the tax assessment. Because at the point in time that you're going to retire, let's say age 65, and you're going to start pulling money out of these retirement accounts, the IRS is going to control what percentage of that account value actually belongs to them. And this is a game that they're going to be playing for the rest of your life, because remember, they have time on their side of the ledger. Can you imagine you entering into a business relationship with someone other than the IRS, and that the person says to you, you know what, John, I'm going to allow you to, I'm going to give you some money right now, and you can use that money to grow your business. I'm not going to charge you an interest rate right now because I don't need the money. But at some point in time in the future, I'm going to come to you. I'm going to say, hey, John, you know what? It's time to pay me. And at that point in time, that could be 20, 25, 30, for many of you, 40 years down the line by the time that you retire. And at that time, your business partner is going to say, now, John, I'm going to determine what's going to be the interest rate that you're going to pay me. And we're going to make that interest rate retroactive to the first day that you went into business with me. Now, how many of you, and do you think that John would ever go in business with someone or a situation like that? The answer would be absolutely not. But the challenge is that most of you, because of the fact that you're playing checkers with your money, you are doing that every single day of your life, except that the IRS is your business partner. Now, remember also that your annual tax deductions were merely a loan from the IRS. So whenever one of your tax preparers says to you, you know, let's put money into a pre-tax account because you're going to save money on taxes, stop them right there and tell them, no, that's not correct. I am not going to save any money on taxes. I am going to postpone the tax, and when I postpone the tax, I'm going to be postponing the tax liability, as well. Another point is that at retirement, you know, the IRS is going to limit your deductions, exemptions, and credits, which may automatically increase your tax liability. See, when you're working, let's say you own a home, you're paying a mortgage, you're taking mortgage interest deduction, you're putting money into your qualified plans, so you're taking those deductions while you're working. You may have children, so you may be taking a deduction and an exemption on your children as well. But by the time each and every one of you retires, then the rules of engagement have totally changed. And the reason for that is by that point in time, for many of you, your mortgage is already paid for. And if it's not paid for, you've been paying for so long that the vast majority of the mortgage payments are going toward principal and not to interest, so the tax deductions are minimal. Because of the fact that you're no longer employed, therefore you're no longer making contributions to these retirement accounts. And obviously you can't take a deduction on those because you're no longer employed. Your children, your kids are already grown up. Not some of them may still be at home, but guess what? You can't take a tax deduction on them whatsoever. And if you were making, charitable contributions while you were employed, and taking those deductions as well, then once you retire, you start actually shifting out of making charitable contributions to devoting more of your time to a charity and contributing less. Now, the IRS does not give you a tax deduction on your time, so those are things that are important for you to know, because even if taxes were not to go up in the future, your tax liability will more than likely will, and you've been thinking all along, because of the fact that you have been playing checkers, that you were going to be in a lower tax bracket in retirement. Now, I want to kind of bring your attention to another point that I often make in my webinars and seminars, is that, greed, for lack of a better word, is good for the IRS. Now, if you all recall the movie Wall Street, that was a statement that Gordon Gekko made in that movie, and he said, and I quote, "Greed, for lack of a better word, is good." I just went ahead and put the IRS name there, but he said that greed, for lack of a better word, is good. Now, and why am I saying this? Is that most Americans are too greedy, and most of you are actually too greedy for Roth conversions, and many of you have a very short view mentality. See, you rather have the pain in the future, although the pain is going to be much bigger and much larger than you've ever thought it would be, as opposed to having a little bit of pain today. So if you are at a point in time in your life where you may be now eligible to making Roth conversions, when you do a Roth conversion, then you have to pay the tax in the year that you're making that conversion. But so many of you are so greedy that you refuse to actually making those Roth conversions because you would have to pay the tax in the year that you're making that conversion. Although we only have a 6-year window left in the Tax Cuts and Jobs Act, in which the standard deductions have been increased and the tax brackets have been reduced. So you're actually living in the third lowest historical tax rate in our country's history, and yet you don't want to pull the trigger and do that, knowing that taxes in the future are going to have to be a lot higher than they are today if we are to remain a solvent country and not have to file corporate bankruptcy and country bankruptcy moving forward into the future. So, and that also brings about the fact that most of you have a very short view mentality of retirement planning, retirement distribution, because the rules of engagement totally change when you go from accumulation to distribution. In distribution, cash flow and guaranteed cash flow and tax-free cash flow is king. Or queen, for those of you listening to this conversation, but most of you are doing totally the opposite. And one final thought before we get to step 4, which are the strategic options, is that the IRS, in all qualified accounts, all of them, the IRS will collect 5 to 8 times more in taxes than those loans that they gave you while you were taking those tax deductions and accumulating for your retirement. So the question that I ask all of you is, whose retirement plan were you planning for? Yours or the IRS's? Now, does that mean that you don't have to put money into your qualified plan? Absolutely not. You need to contribute to your qualified plan, but you have to contribute optimum amounts and up to certain optimum levels that most of you have never even thought about, and you wouldn't even know where to start. So either go back to your tax preparer, go back to your financial advisor, or in a best case scenario, if you want to talk to someone who's a retirement strategist and a tax planner, then feel free to contact me, and I'll give you my information at the very end. And we only have a few minutes left on this podcast, so I'm glad that you're still with us and listening. So what are the strategic options that all of us should be considering? All of you should be considering. Number 1, you need to start playing chess instead of checkers. And that's something that you have to start doing immediately, because if you're going to beat the IRS, you have to be able to beat them at their own game. Now, you need to also control the impact of the COVID-19 stock market and issues and losses that we're dealing with right now on all of your retirement accounts. See, one of the things that most Americans don't realize is that there's something that I call the retirement kill zone. And the kill zone is that area, that diameter where if you're in a war, and I'm a U.S. Marine, if you're in a war and you're going to set up some booby traps and you're going to set up some claymore mines, when the enemy gets into the claymore mine kill zone, that means a diameter all around where anything that's within that diameter is going to die the minute that explosion goes off. So what is the kill zone for each and every one of you in retirement? What has happened now with the COVID-19 virus, and the fact that it's been a bear market virus. Most of you that have done very well in the last 3 years prior to this bear market, have already lost in a matter of a month all of those gains that you have had in the last 3 years. And things are going to get worse because of all the stuff that I talked about early on this podcast of the fact that the COVID-19 virus is only a catalyst to what's to come. So what is the kill zone for your retirement and for your retirement life? Is the first 5 years or the preceding 5 years prior to retirement and the first 5 years post-retirement. So that 10-year window, the 5 years before the day that you retire and the 5 years post-retirement is what I call the retirement kill zone. And the reason why I call it the retirement kill zone is that any financial mistakes that you do in that and that you make in that 10-year window can be detrimental to yourself, your family, and your retirement well-being. Now, you also want to limit, as part of a strategic option, your qualified plan contributions. You need to start shifting those contributions from qualified to maybe Roth IRAs, Roth 401ks, 7702 plans, municipal bonds, where, yes, you're paying the tax now, but then the benefits are going to be tax-free for the rest of your life. Now, if you're making, let's say, $15,000 of contributions to your 401ks or $19,000 in contributions to your 401ks, as many of my clients were prior to visiting with me, if you're making $15,000, and perhaps split the ticket, put $7,500 into your traditional 401k, and you can put the other $7,500 into your Roth 401k if your company has a Roth 401k available to you. At least you're starting to diversify that tax risk that you're going to be facing at retirement. You also want to try to maximize your tax-free bucket. As you know, there are three major IRS buckets that they deal with: the taxable, tax-deferred, and tax-free. Taxable bucket, everything is taxed. Tax-deferred, we've been talking about this in this podcast. Those are your pre-tax contributions, tax-deferred growth, and taxable distribution. And then your tax-free bucket, which is made up primarily of Roth IRAs, Roth 401ks, municipal bonds, and 7702 plans. Now, be careful with the amount of contributions that you make to a municipal bond, because you don't want those distributions in the future to have a negative impact on your Social Security benefits and perhaps even your Medicare premium. So, those are things that I caution you on. But of all three buckets, the bucket that should have the vast majority of your assets should be the tax-free bucket. What I normally find is, because of improper planning and improper management of assets, the vast majority of you have most of your money in either the taxable bucket or the tax-deferred bucket. And then, obviously, last but not least, you want to create and adhere to a tactical retirement blueprint, and that's something that I specialize in from a business perspective. Number one, you want to create guaranteed income cash flow in retirement. And believe me, guaranteed income will supersede any income that you can get. So if you can wake up every morning knowing that there's a guaranteed paycheck coming to you every single day for the rest of your life, you're going to have a much better life than you would otherwise if you had to guess as to what my retirement income is going to look next month or the month after that, because you have all of your money invested in the stock market. Also, by creating a tactical retirement blueprint, you're going to have the ability to reduce and or eliminate your taxes in retirement. And if I have enough time on my side, then I can pretty much eliminate your taxes in retirement. For some of you, I'm definitely going to be able to reduce it significantly, which again is going to make your retirement life a lot more successful than it would be otherwise. Number three, By doing a tactical retirement blueprint, you'll be able to reduce and or eliminate your Social Security taxation. So if I can get you from 85% to 50% or to 0%, then that would be the best world that you should be able to find yourself in. You also, by doing a proper tactical retirement blueprint, you would also have the ability to reduce and or eliminate your Medicare excess premiums, which are the ones that I've talked about already. And then last but not least, a tactical retirement blueprint will allow you to create tax savings, and these tax savings that you will be able to recapture and recover will assist you in funding your long-term care liabilities and expenses in the future. So again, at the end of the day, the name of this podcast is While You Play Checkers with Your Retirement Assets, the IRS is Playing Chess. So how can you start making a paradigm shift immediately in which instead of playing checkers, you're going to start playing chess? Now, for those of you that want to learn how to play chess with your retirement assets and your retirement planning, please feel free to call me. You can call me at area code 786-766-1042. You can reach out to me and email me at Bert, B-E-R-T, at gablestaxgroup.com. You can also send me an email at an email address, and I'm going to start using now more often than not, which is Bert, B-E-R-T, at bertsalazar.com. That would be B-E-R-T at BERTSALAZAR.com. And always remember that my goal for all of my online listeners and followers, all my clients, all of you that have given me your trust by listening to my podcast on a weekly basis, is to help you and your family change the way that you see things. Because when you change the way that you see things, the things that you see change. So once again, thank you very much for your time, and I'll talk to you soon. Take care. Bye-bye.